Manishi Raychaudhuri is Asian equity strategist at BNP Paribas. Manishi, good to have you with us here. Thank you very much for your time. I mean, you look at broadly Asian markets. I don't know if you were waiting for that Bank of Japan decision today, but well, seems like it's nothing. The decision was delayed. Maybe they were having a few more chai, samosas and chai or whatever, but it's the last big central bank, and that's why I guess there was a fair bit of anticipation after that Nikkei report that maybe they will make a tweak, but nothing. So in that sense, that one large risk out of the way, what's your view, markets from here?
So, if you look at the Asian or emerging markets, as a whole, they have begun to revive in the second half, and that's something we also anticipated. In fact, in our second half outlook, we actually wrote that. We said that we're turning more positive on Asian equities in the second half of 2023 for two or three simple reasons. First, the monetary policy trajectory of the global central banks is much more visible now than it was about 6 months ago. One doesn't know whether the Fed would hike once more in September, but whatever that outcome may be, it's now clear that we're at the fag end of that rate hike cycle. Second, Asian currencies are actually stabilizing. They had depreciated all throughout 22 and possibly the first half of 23, particularly the first quarter. But now it's clear that they're likely to stabilize more. We also have a situation where the Asian central banks may actually be in a position to cut rates, from early 2024. Finally, we're also seeing more earnings estimate upgrades across Asia than we were seeing about 6 to 8 months ago. So some of the large sectors in Asia, like Korean tech, like Indian industrials, they have joined in, which wasn't the case earlier. When I look at closer home in India, it was only financials all throughout the second half of 2022 and early 23. But there are now more sectors, even in India and in the rest of Asia, which have joined in that club of earnings estimate upgrades. So these are clearly positive signs, and while we may still continue to have some degree of sideways movement in the Asian markets on account of the still prevailing recessionary concerns in the developed markets, broadly, the situation clearly looks better than it did about 6 months ago.
Okay, good to have that view, Manishi. Good to have a positive sort of statement this Friday morning. By the way, the market is selling off. I just want to point that out. We went very close to yesterday's low. Exactly took support there at 19,602 thereabouts. You can see the Nifty is pretty much, kind of slid down to the lows of the session. Need to watch out for the banks. It's once again the banks that are leading the decline. Look at the bank Nifty now. It's down over 0.5%. And Manishi, that was my next question to you. Completely take your point that banks led the India rally last year. They are the darling sector for a lot of foreign investors. But what's happening now? We've got our share of foreign money right from April onwards. But the banking index, large banks, they've pretty much been sitting out or, they've been at the periphery of whatever move we've had so far in India. So what do you think is going on here? There's nothing wrong with earnings, at least as of now. Most large cap names have reported pretty healthy numbers.
Absolutely. I think it's that classic case of very large investments having gone in over the past 6 to 9 months. And therefore, investors taking a breather on a particular sector. There's nothing fundamentally wrong, as you pointed out. One thing we must take cognizance of, which is that going forward, the kind of NIM expansions that we had seen for the banks, that's unlikely to happen. In fact, you might even see for some select banks some NIM contraction, interest margin contraction. So I think some investors are also taking cognizance of that. But if I look at the longer term, over the next 2-year, 3-year, 5-year cycle, then the private sector banks in India are in a very sweet spot. We have credit growth about 16 to 17%. The private sector banking universe is constantly gaining market share. Their asset quality is very decent. And on top of that, we have a situation where the corporate universe in India is highly underleveraged. If you look at the top 500 companies, their debt to equity ratio is hardly about 45% or so, and that's a decadal low. So obviously, the companies, when they get into the next capex cycle, they have room to leverage upwards. So I think this short-term underperformance of the banking sector is nothing to worry about.
Okay, so positive on Asian emerging markets, including India, for the second half, and no cause to worry about the banks. Got that. A lot of earnings today, so we'll have to keep it a little short this time around. Thank you very much for joining in, Manishi, and we look forward to a longer conversation next time. You have a good one.